Hey Money Mavens, welcome back to your channel name. Today we're diving into something that feels like navigating a ship through a stormy sea, investing during a crisis. Yep, when the economy's shaking, stocks are tanking, and everyone's panicking, how do you keep your wealth safe and maybe even grow it? Don't worry, I've got you covered with 5 rock-solid strategies to protect your money, even when the world feels like it's falling apart. Plus, we'll sprinkle in some inspiring stories of entrepreneurs who turned crises into cash. Because who doesn't love a good underdog story? Grab a snack, get comfy, and let's jump in. All right, let's kick things off with strategy hash 1. Stay calm and don't panic sell. Picture this. The stock market's crashing, your portfolio's looking like it took a nosedive off a cliff, and your neighbor's yelling, "Sell everything." Sound familiar? It's tempting to join the chaos, but here's the deal. Panic selling is like jumping out of a plane without a parachute. You're almost guaranteed to crash. Let's break it down. When a crisis hits, like the 2008 financial meltdown or the 2020 COVID crash, markets go wild. Fear takes over, and people start dumping their stocks faster than you can say recession. But here's the thing. Markets always recover. Always. History shows it. After the Great Depression, after the dot-com bubble, after 2008, every time the market bounced back. Selling in a panic locks in your losses and means you miss out on the recovery. Now let me tell you about a guy who didn't panic. Warren Buffett. You've probably heard of him, the Oracle of Omaha, one of the richest dudes on the planet. Back in 2008, when everyone was freaking out about the housing market collapse, Buffett didn't sell. Nope. He stayed calm and bought. He scooped up shares of companies like Goldman Sachs at rock bottom prices. Why? Because he knew the crisis would pass, and good companies would come back stronger. By staying cool, he turned a scary moment into a massive win. Today, his company, Berkshire Hathaway, is worth billions, partly because he didn't hit the panic button. So, how do you stay calm when your portfolio's screaming at you? First, zoom out. Look at the big picture. If you're invested in solid companies or index funds, remind yourself they've got a track record of bouncing back. Second, turn off the news. Seriously. Those 24/7 headlines about market Armageddon are designed to make you panic. And third, have a plan. If you know your investments are built for the long haul, you're less likely to freak out when things get shaky. Let's make this fun. Imagine your portfolio is like a roller coaster. When it's dropping, your stomach's flipping, but you don't jump off mid-ride, right? You hold on because you know it'll climb back up. That's investing during a crisis. Hold tight and don't let fear make you do something you'll regret. All right, strategy hash 2. Diversify like a pro. You've heard the saying, don't put all your eggs in one basket. Well, in a crisis, that's not just advice. It's gospel. Diversification means spreading your money across different types of investments, so when one takes a hit, the others can hold you up. It's like having a financial safety net. Think of it like a buffet. If you only load your plate with pizza and the pizza runs out, you're starving. But if you grab some pizza, salad, pasta, and dessert, you're good no matter what. In investing, your buffet includes stocks, bonds, real estate, commodities like gold, and maybe even some cash. When one part of the market, like tech stocks, crashes, others, like bonds or gold, might stay steady or even go up. Let's talk about an entrepreneur who nailed diversification, Elon Musk. Yeah, the Tesla and SpaceX guy. During the 2008 financial crisis, Musk was in a tough spot. His companies were bleeding cash, and the economy was a mess. But Musk didn't bet everything on one idea. He had Tesla for electric cars, SpaceX for rockets, and even SolarCity for solar energy. By spreading his bets across different industries, he cushioned the blow. When one company struggled, the others kept him in the game. Today, he's one of the world's richest people, and diversification was a big part of his survival strategy. So how do you diversify? Start with a mix of asset classes. Stocks are great for growth, but they're volatile. Bonds are more stable and pay interest. Real estate, like REITs, real estate investment trusts, can give you steady income. And don't forget gold or other commodities. They often shine when stocks tank. A simple way to diversify is through index funds or ETFs, which spread your money across hundreds of companies in one go. For example, an S&P 500 ETF gives you a piece of the 500 biggest U.S. companies. Talk about a safety net. Here's a pro tip. Check your portfolio every few months and rebalance. If stocks grow too much and take up 70% of your portfolio when you wanted 50%, sell some and buy bonds or other assets to get back to your target mix. It's like trimming a hedge to keep it neat. And during a crisis, diversification can save you from losing it all. Fun fact, During the 2020 COVID crash, while tech stocks like Zoom and Amazon soared, oil stocks tanked. Investors with diversified portfolios didn't feel the full pain because their winners balanced out their losers. So channel your inner Buffett chef and mix it up. Moving on to strategy hash 3. Focus on quality investments. Not all investments are created equal, especially in a crisis. When the economy's in chaos, you want to bet on companies that are like the cockroaches of the business world, tough, resilient, and able to survive anything. What makes a quality investment? Look for companies with strong fundamentals, low debt, steady cash flow, and a business model that doesn't depend on people splurging. Think consumer staples, stuff people need no matter what, like food, toothpaste, or electricity. These companies don't just survive crises, they keep chugging along. Let's talk about an entrepreneur who thrived by focusing on quality. Jeff Bezos. During the dot-com crash in 2000, tons of internet companies went bust. But Amazon, led by Bezos, survived. Why? Because Amazon focused on what customers needed: cheap, reliable online shopping. Bezos kept costs low, built a loyal customer base, and didn't load up on debt. While other dot-coms collapsed, Amazon came out stronger, paving the way for it to become the giant it is today. How do you find quality investments? Start by checking a company's balance sheet. Low debt is key. Think of it like a friend who doesn't owe money to a dozen credit cards. Look for consistent profits and a history of weathering storms. For example, companies like Procter & Gamble or Johnson & Johnson have been around forever and keep paying dividends even in tough times. If you're not into picking individual stocks, go for ETFs focused on dividend aristocrats, companies that have raised dividends for 25 plus years. These are the rock stars of reliability. Here's a fun way to think about it. Quality investments are like picking a teammate for a zombie apocalypse. You don't want the flashy guy who brags but can't run. You want the steady, prepared one with a bunker and a year's supply of food. In a crisis, boring is beautiful. Strategy hash 4. Keep cash on hand. I know. Cash feels boring when stocks are zooming or crypto's going to the moon. But in a crisis, cash is your superhero. It gives you flexibility, safety, and the power to pounce on opportunities when everyone else is broke. Here's why cash is king during a crisis. First, it's your emergency fund. If you lose your job or face unexpected expenses, cash keeps you afloat without selling your investments at a loss. Second, it's your war chest. When markets crash, quality assets go on sale. Think stocks, real estate, or even businesses. If you've got cash, you can buy low and win big when things recover. Let's look at an entrepreneur who used cash to win big, Mark Cuban. During the 2008 financial crisis, Cuban, the billionaire owner of the Dallas Mavericks, had plenty of cash on hand. While others were stuck, he snapped up undervalued assets and invested in startups at bargain prices. His cash gave him the freedom to act when others couldn't, and it helped him build his empire even bigger. So, how much cash should you keep? Aim for 3-6 months of living expenses in an emergency fund, parked in a high-yield savings account. Beyond that, consider keeping 10-20% of your portfolio in cash or cash equivalents, like treasury bills. These are safe, liquid, and ready to deploy when opportunities pop up. Just don't stuff it under your mattress. Inflation's a sneaky thief. Think of cash like your secret weapon in a video game. You don't use it all the time, but when the boss fight comes, you're glad you saved it. In a crisis, cash lets you play offense and defense at the same time. Finally, strategy hash 5. Think long-term and buy the dip. Crises are temporary, but wealth is forever, if you play it smart. When markets crash, it's not just a disaster, it's a clearance sale. The best investors don't just survive crises, they use them to get richer. Buying the dip means scooping up quality assets when prices are low. But here's the catch. You've got to think long-term. If you're trying to flip stocks in a week, you're gambling, not investing. The goal is to buy great companies or funds at a discount and hold them for years, letting them grow as the economy recovers. Let's talk about an entrepreneur who mastered this. Sara Blakely, the founder of Spanx. During the 2008 recession, while retail was struggling, Blakely saw opportunity. She invested in growing Spanx when costs were low. Cheaper manufacturing, cheaper marketing. By focusing on the long term, she turned Spanx into a billion-dollar brand. Her mindset? Crises create chances for those who don't lose sight of the big picture. How do you buy the dip? First, stick to quality, those cockroach companies we talked about. Second, use dollar cost averaging. Instead of dumping all your money in at once, invest a set amount regularly, like $500 a month. This way, you buy more shares when prices are low and fewer when prices are high. It's like getting a deal without trying to time the market perfectly. Third, be patient. Markets can take months or even years to recover, but they always do. Here's a fun analogy. Buying the dip is like snagging a designer jacket at a thrift store. It's worth $1,000, but you get it for $50 because someone else panicked and gave it away. Hold on to it, and it's still a $1,000 jacket. That's the power of thinking long-term in a crisis. All right, money mavens, let's wrap this up. We've covered 5 killer strategies to protect your wealth during a crisis. Stay calm and don't panic sell. Diversify like a pro. Focus on quality investments. Keep cash on hand and think long-term while buying the dip. These aren't just tips. They're your playbook for turning scary times into opportunities, just like Warren Buffett, Elon Musk, Jeff Bezos, Mark Cuban, and Sarah Blakely did. Crises are like storms. They're loud, they're messy, but they pass. And when they do, the investors who stayed smart, stayed calm, and stayed strategic are the ones standing tall. So take a deep breath, make a plan, and don't let fear run your money. Now, I want to hear from you. Drop a comment below and tell me, which of these strategies are you going to try? Have you ever invested during a crisis? Or are you prepping for the next one? And if you love this video, smash that like button, hit subscribe, and ring the bell so you never miss a tip to grow your wealth. Check out our playlist on personal finance for more ways to make your money work for you. Until next time, keep investing smart, and I'll see you in the next video.